Alright ji. Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Today we are going to study about one new accounting standards that has been recently published, and it has been included in ACCA's SBR's course recently. And generally it is quite acceptable, and it is quite accepted that any accounting standard that is newly introduced in your syllabus, examiner is most likely going to test it. It's something which is not very lengthy. It's just a two-pager handout, and if it was a full A4 size paper, it would have been covered under one paper. Yeah, so one page handout only, literally. All right. So IFRS 19 is one area which truly focuses on disclosures. We are going to go around this accounting standard and see the implications of this accounting standard on companies, on investors, and why this particular accounting standard has been introduced. We'll go through it. We'll discuss about it. The whole idea is that you see this lecture once, get the concept, and then do not see this IFRS, do not revise this IFRS until last day before your exam, so that you do not spend any unnecessary time on it. All right, so let's understand this very carefully within this session and do not spend time later on. All right. So IFRS 19, guys, IFRS 19 is a disclosure based accounting standard. The name of this accounting standard is Subsidiaries Without Public Accountability. Now the name says it all. This is one accounting standard which is going to focus on disclosures, number one. Number two, it is going to focus on disclosures for those type of entities which are subsidiaries. Sir, what do you mean? We are only going to talk about those type of companies which are subsidiaries. Sir, what do you mean? There must be a parent above you. There must be a parent above you. IFRS 19 is not focused on each and every company, but only that type of a company which can be termed as a subsidiary as per IFRS 10. So you are being controlled by another company which is your parent, or maybe another company which is your parent's parent, the ultimate parent, but you must be a subsidiary of some other company. All right. Sir, does IFRS 19 apply on each and every subsidiary in this world? No. IFRS 19 only applies to those group companies or those subsidiaries that are without public accountability. That are without public accountability. That are without public accountability. And I'm repeating this again and again. Three things you need to consider within the name of IFRS 19, and you repeat it after me because you are not going to revise this accounting standard anyhow. Yeah. So three things that you need to focus on. IFRS 19 is about disclosures. Number one, IFRS 19 focuses, or IFRS 19 is only applicable to subsidiaries. So that means you must have a parent company above you, or an ultimate parent above you. Number three, it is only applicable to those type of subsidiaries who do not have public accountability. Sir, what do you mean by they do not have public accountability? It means that you are not engaged with public funds anyhow. Neither you are a government company, so you have no relation with public's money, nor you have taken money from public privately. For example, your debt is not traded in the market. Your debt instruments are not traded on the market. Your shares are not traded on the market. So technically speaking, a subsidiary without public accountability is a subsidiary which is a private company. Yeah. A subsidiary without public accountability is generally a private company. So for a private company, generally your debt or equity instruments are not listed on public forums. So you are not exposed to public interest. You're not exposed to public accountability. And only these private companies are within the purview of IFRS 19. And let me ask you one question. You give me your own thought process. We'll read out IFRS 19 later on, but you just give me out your thought process. So IFRS 19 is only applicable to private companies that are subsidiaries of their parent. All right. Do you think it is a necessary requirement that your parent company should also be a private company? Your parent company should also be a private company. Is it a requirement under IFRS 19? Should it be a requirement under IFRS 19? No. No, very good. Your parent company or your ultimate parent company can be a corporate company. Its debt or equity instruments may be traded under many stock exchanges on many public forums. That is acceptable. But the entity itself should have no public accountability. The entity itself should be a private company. Understood? And see, IFRS 19 is quite relevant for some type of companies. I'll give you some examples. I'll give you an example from Pakistan itself, right? So there is a company whose name is Philip Morris. How many of you know about Philip Morris? Specifically the ones who are living in Pakistan, or maybe if you're living abroad as well. Do you know about Philip Morris? Now, Philip Morris is a company which might be quite relevant for some people, at least for some boys. Philip Morris is a company which has a very well known brand, at least for boys. They are the they are the producers of Marlboro. Marlboro, you understand what is Marlboro? How many of our class students know about Marlboro? You don't know? Very good. Excellent. So any person who is saying yes, this screenshot will be taken and given to your parents so that they know. Rehan is saying, sir, obvious. Obvious. Now this screenshot is being taken and being sent to your parents. Okay. So Marlboro is basically a nicotine or a cigarette brand. They have multiple products as well. But basically, okay, they have gold leaf as well. I don't know about it. So what I was saying is, so Philip Morris is basically a company which globally sells, cigarettes and everything. It's basically a nicotine brand, a very well known and a famous brand. All right. So Philip Morris is basically a US company. All right. So recently I saw a public notification on stock market website from Philip Morris that it's a US based company, and they sent a public notification onto the stock market, Pakistan Stock Exchange, that they want to delist Philip Morris Pakistan, and the parent company wants to buy all shares. Yeah, I'll give you another example. So this is another example that I've been exposed to. For example, there is a company known as Siemens. Now, Siemens is a multinational company present in almost all parts of the world. Yeah, they have a public subsidiary in Pakistan as well. But recently, without implying anything, but recently you guys might have seen it's a public company and a subsidiary of Siemens AG. And recently, what Siemens AG has been doing, they have been buying shares of Siemens Pakistan through the stock market. So, in order to increase their shareholding. And what will happen most likely? I mean, that's pretty much common sense. What will happen? Siemens Pakistan might become a company without public accountability once your parent company has acquired all the shares through the stock market. All right. So, what I'm trying to make you understand, let's go back to the example of Philip Morris. Now, Philip Morris is a US based company. It's a very well known company. It has a very good share price in US stock market, and it sent a public notification that it wants to delist Philip Morris Pakistan from Pakistan Stock Exchange by investing further in Pakistan and acquiring all their shares which are there in the market. Now, once that has been done, what will happen? Philip Morris Pakistan will eventually become a private company. Philip Morris Pakistan will eventually become a private company. Now, what could be the benefit for Philip Morris US of having a private company in Pakistan? What would be the benefit to them? Now, there can be some business benefits, there can be some control benefits, there can be some ownership benefits. I agree. But there can be some governance benefits as well. There can be some regulatory benefits as well. You are absolutely correct. There are some regulatory benefits of becoming a private company as well. There are some governance benefits as well if you become a private company. So, for example, like in every other country, if you're a public company, you are exposed to the stock market listing requirements. You are exposed to different laws and regulations that are applicable on large scale companies that have arranged finance from the public. So you're exposed to detailed regulation. I mean, you should have a board of like 7 people. You should have this much women in board. You should have an independent audit committee. You should have a remuneration committee. You should have this. So a lot of hassle, a lot of regulation goes around when you are a company with public accountability. And plus, if you are a public listed company, although it can have benefits to you as well because you can raise finance, but if you're a public company, you have to provide financial statements in detail. So you have to go towards each IAS and IFRS disclosures as much as required by IFRS. So you have to go for detailed disclosures. And guys, whenever a company has to provide detailed disclosures, it has to make sure that it maintains sufficient data in the background so that tomorrow they can provide detailed disclosures. So a lot of finance, a lot of accounting, a lot of bookkeeping, a lot of storage of data goes into play just because you are a public company and you want to publish financial statements with full disclosures. So, if you understand, a company with public accountability might have a lot of regulatory burden on it. A company with a lot of public accountability might have a lot of regulatory burden on it in terms of how it operates and also in terms of how it produces its financial statements, because you have to provide detailed disclosures as per IFRS. Allowed? Agreed? A lot of cost is incurred too, obviously. Now, okay, it is totally acceptable that if you're a private company, sorry, if you're a public company, you have raised finance from the public. And therefore, if the regulatory bodies require you to produce financial statements with detail and with all disclosures, I mean, you have raised finance from the public, the governments are responsible to ensure interest of public money and they are responsible to ensure well-being of public interest. So they require you detailed disclosures. If they require you detailed disclosures, you must be giving detailed disclosures, right? But what happens if, for example, Philip Morris US has a private company in Pakistan? Should they still be providing detailed disclosures? Just try to understand. Huh? Just try to make yourself understand. Philip Morris US is a company. Yeah, it's a public company. It has a wholly owned, 100% owned subsidiary in Pakistan, Philip Morris Pakistan. It's wholly owned by them. Should they still produce detailed disclosures? Should they still produce detailed disclosures in financial statements? I mean, from a common sense point of view, they should not be providing detailed disclosures in financial statements because the company which owns them 100%. And there are internal control guidelines and internal audits and internal information sharing on a daily basis. So technically, Philip Morris US already knows what Philip Morris Pakistan is doing. I mean, their ERP would be the same. Each and every information would be real time updated. Do they really need to tell them on a detailed disclosure basis? The answer is no. Internal members, your shareholder is technically controlling you 100%. Their employees are sitting in your office. Their employees are sitting in your board. Technically, they know 100% what you do. Actually, you are copying. The Pakistani entity would be copying the US entity. So the US entity knows everything. Should they be providing detailed disclosures in FS if you're a 100% owned subsidiary of a company? Technically, no. Yeah, technically, no. It would be so much cumbersome for a private company like Philip Morris Pakistan. If it becomes a private company, it will be so much cumbersome to produce detailed financial statements disclosures just for your parent company who already knows your whereabouts. Who already knows your whereabouts. They know everything. Yeah. So previously, there was no accounting standard in the IFRS regime. There was no individual accounting standard that saw this need that private companies or subsidiaries without any public accountability should be given the opportunity for reduced disclosures because their ultimate parents knows about them. They know about them completely. Before IFRS 19, there was no one accounting standard that was there to address this issue. So a lot of efforts and a lot of cost was incurred in order to produce full IFRS detailed financial statements. And then IFRS 19 came. So when IFRS 19 came, first of all, it gave the rationale that why IFRS 19 is actually important. And we'll read down this handout and understand why IFRS 19 is actually important. We have had the preamble. I've already told you, it could be very much cost efficient to produce financial statements if you're not providing full detailed disclosures to your parent company. But again, we'll read this handout and get ourselves pretty much clear as well. One thing that you need to know about this accounting standard is that it is applicable for companies mandatorily from 1st June 2027. So its applicability is in future, first of all. And second of all, remember that it is an optional accounting standard. Please write it down somewhere. This standard, please write it down whenever you get the opportunity. This standard is optional for subsidiaries. So subsidiaries of parent companies can decide to apply IFRS 19 if they want to. And what's the interesting part? There can be a subsidiary which starts to apply IFRS 19 now, and then maybe after 2 years it decides, I don't want to apply IFRS 19, I want to provide full detailed disclosures because, for example, my parent company requires me to provide full disclosure. Or for example, there is an acquisition bid and the buyer wants to know everything in detail, and that is why the buyer is trying to convince you to provide full detailed disclosure, for full detailed IFRS related disclosures. If that's the case, you can opt out of this accounting standard. You can opt in this accounting standard on a voluntary basis. You can opt out of this accounting standard on a voluntary basis. And what's the fun part? For example, after 2 years, you decide that you want to go with full IFRS, you go with full IFRS disclosures. And then after the third or fourth year, if you again decide that you want to apply IFRS 19, it also allows you to reapply IFRS 19. So unlike any other accounting standard, it gives you full liberty. It gives you full liberty. Yeah. So this is a matter, since it is not a subsidiary with public accountability. It's a privately owned entity. It is up to the owners of the entity or the managers of the entity. They can decide what they want to do. All right. So this is the most important part to remember. It is an optional accounting standard on each and every entity. Right. What does it say? Please listen to me very carefully. It says that parent companies, parent companies that produce consolidated financial statements under IFRS accounting standards have to choose whether their subsidiaries prepare financial statements under IFRS or local GAAP. So generally, parent companies have to decide if they want their subsidiaries to apply IFRS or local GAAP. Local GAAP you must apply. But many subsidiaries all over the world have to produce IFRS set of financial statements as well, so that their parent company can consolidate them. So it's already a lot of effort for subsidiaries which are not applying IFRS. They are applying local GAAP. It's already a lot of stress for them. They say that if the subsidiary is applying IFRS, the financial statements of the parent and the subsidiary can have the same accounting policies, making the preparation of consolidated financial statements easier. So if both your parent and subsidiary companies actually apply IFRS, it is easier to consolidate, pretty much common sense. However, this is the main issue that we are discussing under this accounting standard. The IFRS disclosure requirements can be onerous for a subsidiary to prepare. So even if your subsidiaries applies IFRS, maintaining data for all the detailed disclosures which are required under IFRS can be cumbersome. We are not asking subsidiaries not to apply IFRS. Please be clear. We are encouraging entities, even the smaller entities, to apply IFRS. It is just the disclosure requirements that we are allowing some relaxation on. Understood? Is it clear to everybody? So it's just the disclosures for which we are providing relaxation, right? So it can be, so you need to clearly remember that even if a subsidiary applies IFRS, still the accounting measurement classification requirements still you have to apply, right? It's just the disclosures that you are being relaxed on. Then, even if a company applies IFRS, subsidiary may have to prepare and retain extra set of records in order to bridge any differences with the consolidated financial statement. So it's already cumbersome for entities that apply local GAAP. They have to, spend a lot of money and cost, and there are certain data requirements and storage requirements and multiple accountants and multiple efforts and staff and everything, so that they maintain detailed disclosures with themselves. So basically what IFRS 19 actually offers is it offers reduced disclosure requirements. Yeah. And again, in your examination, you are not required to prepare any disclosure. That's the best part. You are not required to prepare any disclosures, but at least you should know that certain accounting standards require a disclosure for some things. So you only need to know that a disclosure is required, but you're not required to prepare one in your exam. So IFRS 19, what it actually offers is that in order to reduce the burden of the disclosures for a subsidiary, an entity can choose. Remember, IFRS 19 is all about choices. You can opt in this accounting standard. You can opt out of this accounting standard. Again, you can opt in this accounting standard. It is completely your choice. And obviously, your choice will be driven by the requirement by your parent. But again, we want to encourage companies to stay with IFRS. We want to encourage companies to apply IFRS as far as the accounting is concerned, measurement and classification is concerned, and that is why we are relaxing the requirements on disclosures. All right. So, to reduce the burden of the disclosures for a subsidiary, an entity can choose to apply IFRS 19 subsidiaries without public accountability and have reduced disclosures. So, first of all, you need to understand that what type of a subsidiary can apply IFRS 19. You must be an eligible company. You must be an eligible subsidiary so that you can apply for the relaxation of IFRS 19. And for that to happen, you must be a subsidiary without any public accountability, right? You must be a subsidiary without any public accountability. Sir, what do you mean? What is the requirement? What is the eligibility criteria to become a subsidiary without public accountability? The requirement is pretty much easy and clear. You must be a subsidiary as defined under IFRS 10. So there must be a party controlling you. There must be another party who has control over you, and the controls criteria is satisfied as under IFRS 10. You are a subsidiary who does not have any public accountability. What do you mean by not having public accountability? I mean, you are an entity that, for which none of the equity or debt is being publicly traded, and you do not hold any assets in fiduciary capacity. The entity does not hold any public funds, nor their equity or debt instruments are publicly traded. If your debt or equity instruments are not publicly traded, or you are not a public sector government owned entity, you're not a state owned enterprise, then you can apply for this reduced disclosures. And the third requirement is also important. The third requirement you also need to remember. The third requirement is that your parent, the ultimate or the intermediate, whatever, prepares consolidated financial statements that comply with IFRS and are publicly available. So your parent must be applying IFRS and be providing, full set of disclosures. That is one criteria. IFRS 19 is allowing the subsidiary, which may be a smaller entity in another country, to have reduced disclosures. But for that to happen, you have to make sure that your parent company, the ultimate parent or the intermediate parent, the immediate parent, your parent company must be providing full set of financial statements in accordance with IFRS. So if your parent company is not applying IFRS or not providing full set of disclosures, then you cannot apply for the relaxation, because at least somebody has to provide disclosures, right? But if the consolidated financial statements are already with full set of disclosures, then the subsidiary can apply this IFRS 19 and take the benefit of reduced disclosures. Is it clear to everybody? So as far as IFRS 19 is concerned, whenever you revise, just revise these three things. Yeah. So three criterias you revise. Any other thing if you want to revise? I don't think so. Every other thing is literally common sense. If you remember the example of Philip Morris, and most of the boys will. I've got the screenshot as well. If you remember Marlboro, then you'll remember this accounting standard as well. All right. So what actually happens when you are applying reduced set of disclosures? For example, multiple type of disclosures will be reduced. For example, I've set some examples again. You are not required to prepare any disclosures. That is why detailed level of knowledge or detailed level of efforts we are not going to put in. But for the sake of having an experience, for example, under IS7, full IFRS requires you to provide full cash flow detail. So you are required to reconcile your opening cash and cash equivalents to your closing cash and cash equivalents. You are required to provide disclosures how you calculated cash flow from operating activities. You might be required to provide some footnotes as well, anything about exchange differences or things acquired during the year. But if you're applying IFRS 19, again, the statement of cash flows will still be prepared in accordance with IS 7. It is just the disclosure level that will be simplified. You're not required to produce a detailed level of disclosures why and how a particular thing has been determined, but still you will be stating that full IFRS has been applied, regardless you're not providing a detailed. For example, IFRS 7, which is financial instruments disclosures. Although IFRS 7 is not technically within your course, but IFRS 7, um, any student who has done audit in Pakistan or all over the world, and specifically in the financial sector, you might have seen that there are detailed disclosure requirements of IFRS 7. Credit risk, liquidity risk, this, that, ratings, and so on and so forth. Under full IFRS, you have to provide full detailed risk tables. If you apply IFRS 9, then you are required only to produce limited set of information. So reduced requirement is there. IAS 9, IAS 16, for example, you right now generally with full IFRS you have to provide a full movement of your property, plant, and equipment from opening to closing, including all the heads. But if you are applying IFRS 19, you can only provide a condensed table for IAS 16's property, plant, and equipment, and that would be sufficient. All right. There is a question, sir. Can we imply that if parent is not a listed company, then they will be applying IFRS, and so subsidiary will not be qualified for this reduced disclosure? That can be an implication, but generally we will stick to what the IFRS says. You need to confirm that your parent company must be applying IFRS. So either it will be applying IFRS or it won't be applying IFRS. If your parent company, the intermediate or the ultimate, is not applying IFRS, then you cannot take the benefit of IFRS 19. And most likely, most private companies might not be applying IFRS. It can be implied, but it is not confirmed. Definitely. What will be the benefit of this? For eligible subsidiaries, like we discussed the eligibility criteria earlier, the application of IFRS 19 should enable companies to simplify their reporting process and reduce the cost of preparing financial statements. Entities will no longer need to keep two set of records, which is one, the reduced requirements that generally local GAAP have, and one for IFRS. So IFRS will be aligned with your local GAAP and hence be requiring reduced set of disclosures. And remember, this is written under IFRS 19 that if any entity applies the following accounting standards, then the entity must comply with full disclosure requirements. So previously we saw that if your parent company is not producing their consolidated financial statements in accordance with the full IFRS, then you cannot avail the exemptions or the reduced burden of IFRS 19. Furthermore, if the entity is applying any of these accounting standards, IFRS 8 operating segments, IFRS 17 insurance contracts for insurance companies, and IAS 33 earnings per share. If any of these three accounting standards are being applied, then you must follow the full IFRS disclosures. You will not be given this relaxation. You will not be given this relaxation. So if you are already exempt for any of these accounting standards, it will be easier for you to apply IFRS 19 as well. But if you have already failed the exemption of any of these three accounting standards, you will automatically fail for exemptions of IFRS 19 as well. So that's the philosophy. All right. And that is it. IFRS 19 is complete. Let me know if everybody understands this or not. And again, you don't have to revise this again and again. You might revise this just one time, last day before your exam. Is it clear? If everybody understands, just write yes or no so that I know that you know. And for any other person, if you have any questions, feel free to ask. All right. So I want an answer from everybody. Is everybody clear on this? So I believe this is it.